Welcome to the August Cool Quarterly Macro Report. In this report, we'll look at the macroeconomic picture for the US and globally, as well as investment markets, market performance, and the outlook for Q4 and beyond. Nothing we present should be taken as investment advice. We encourage you to do your own research, but we hope that our work gives you some food for thought. The US economy is showing remarkable resilience. Real gross domestic product staged a decisive turnaround, rebounding sharply to an annual growth rate of 3.8% in Q2, entirely reversing the 0.6% contraction seen in the first quarter. This strong performance was primarily fueled by a surge in consumer spending and a significant contraction in imports. Inflationary pressures began to ease, with the core PCE price index slowing to 2.5% annualized, moving closer to the Federal Reserve's long-term target. Despite this progress, the Federal Reserve maintained a cautious stance, holding the federal funds rate steady between 4.25% and 4.50% throughout the quarter. However, expectations for future easing were high, and this culminated in the Fed cutting rates in September, post Q2, reflecting a commitment to supporting growth as inflation cooled. The labor market remained solid, with the unemployment rate ticking down to 4.1% by June, and payroll job growth accelerating, though it showed signs of cooling from post-pandemic highs. On the global stage, the economic picture was more fragile. Global growth, as measured by the OECD, was sluggish at 0.4% quarter-over-quarter, with regional divergences becoming prominent. Major economies like Germany and Italy experienced GDP contractions, and China's recovery lost momentum. The dominant global headwind was the mounting uncertainty surrounding trade policy, with the risk of new U.S. tariffs looming. This trade uncertainty weighed heavily on global growth forecasts and led to a tightening of investment intentions worldwide. Central banks outside the U.S. also made key moves. The European Central Bank, confident in its inflation trajectory, delivered a 25 basis point rate cut in June. Conversely, the Bank of England remained more constrained. Geopolitical risks, particularly the escalation of the Israel-Iran conflict in mid-June, cast a shadow over stability, though, surprisingly, oil prices saw a decline during the quarter. Financial markets responded to the nuanced environment with a rally. U.S. equity markets surged, led by the tech sector and strong corporate earnings. Globally, international equities outperformed U.S. stocks, and bond yields eased in anticipation of future global rate cuts, confirming that investors remained optimistic about the longer-term outlook, despite the clear and present dangers posed by trade disputes and geopolitical tensions. China's economy from July 2025 to today has been on a path of moderating momentum and deepening structural challenges, following a growth spurt that marked the first half of the year. The overall picture is defined by three major forces: a persistent property crisis, rising trade friction, and a supportive yet constrained government response. The most significant headwind remains the property sector crisis. Despite months of government interventions, the market has shown no sign of recovery, with home prices continuing their downward slide across most major cities through July and August. Key developers are struggling to manage massive debt loads, leading to ongoing restructuring and legal proceedings. This decline in asset value is profoundly depressing consumer confidence and overall domestic demand. Compounding domestic weakness is a spike in external uncertainty. The threat of new, higher tariffs from the U.S., which were expected to begin implementation in the third quarter of 2025, has clouded the outlook for Chinese exporters. While exports proved resilient earlier in the year, this front-loading effect has begun to fade, contributing to a noticeable slowdown in manufacturing activity. The official manufacturing PMI has been in contraction territory for its longest streak since 2019. Consequently, the economy is grappling with deflationary pressures, a reflection of weak domestic demand and industrial overcapacity. In response, Beijing is leaning heavily on fiscal stimulus, accelerating infrastructure spending, and continuing with large-scale programs like the consumer goods trade-in scheme. However, these efforts have only managed to slow the decline, not reverse the fundamental shift in sentiment. leaving the economy heavily reliant on government support as it heads into the final quarter of 2025. The Fear and Greed Index is a way to gauge stock market movements and whether stocks are fairly priced. The theory is based on the logic that excessive fear tends to drive down share prices, and too much greed tends to have the opposite effect. At the end of September, the index showed a mixed bag of readings, with equity market prices and options activity showed up as greed readings. Yet breadth in equity markets and other indicators, such as the junk bond market, have a fear reading. While we don't use this index as any part of technical analysis, it is an interesting heuristic. And we can see that the overall index has declined moderately over quarter three. The latest results show a net bullish sentiment, with optimism exceeding pessimism. There are some key observations from the latest results. The 41.7% bullish reading is above the historical average of 37.5%. The 39.2% bearish reading is above the historical average of 31.0%. The 19.1% neutral reading is significantly below the historical average of 31.5%, suggesting fewer investors are undecided and sentiment is more polarized. The data suggests a notable shift in sentiment over the 4-week period. Bullish sentiment has risen sharply from 28.0% to 41.7%, nearly reaching the bullish one-year high. Bearish sentiment has decreased significantly from its high of 49.5% to 39.2%. Neutral sentiment has declined from 23.9% to a low of 16.0%, before slightly recovering to 19.1%. The overall trend shows a rapid swing from majority bearish/pessimistic sentiment to a majority bullish/optimistic sentiment in the last 2 weeks, with the biggest drop in the neutral category. Regarding market breadth, the overall S&P 500 average of stocks above their 50-day moving average decreased slightly from August to September, falling from 63% to 56%, indicating a marginal weakening of the broad market's short-term momentum. Utilities showed the strongest performance in September 2025, with 83%. Consumer discretionary experienced the largest month-over-month increase between August and September, jumping from 47% to 78%. Consumer staples had the weakest momentum. Financials had the strongest momentum in August 2025 at 74%, but saw a significant decline to 58% in September. Energy maintained strong momentum, slightly improving from 68% in August to 72% in September. The dollar experienced a complex and volatile movement over the 3-month period from July to September 2025. This period followed a significant decline in the first half of 2025, the worst performance for the dollar in decades. The dollar index generally displayed a strengthening trend in the third quarter of 2025, recovering some of the steep losses incurred earlier in the year. There was some initial strength in July. The DXY rebounded, posting a notable gain, primarily driven by stronger-than-expected U.S. economic data, particularly in the labor market. After the July rally, the dollar experienced volatility but ultimately continued to push higher into the end of September. This late quarter strength was marked by a decisive break of technical resistance levels, with the index pushing toward the 98 handle. The period spanning the last 6 months for the CBOE Volatility Index was characterized by a broad pattern of mean reversion and subdued volatility, punctuated by brief, sharp spikes of market fear. This behavior kept the index oscillating around its long-term average, a classic illustration of the VYX's nature as the market's fear gauge. Throughout much of this 6-month window, the 200-day simple moving average served as a crucial demarcation line and an anchor for the VIX. The 200 SMA represents the long-term expected mean for volatility, often residing in the middle to upper teens. The period began with the VIX settling from any earlier higher volatility, pushing it to test and often dip below the 200-day simple moving average. A VX reading below this long-term average signals a period of relative market calm and investor complacency, coinciding with generally stable or rising equity markets. The typical summer seasonality, which often involves lower trading volumes, contributed to an extended period where the VIX frequently lingered at the lower end of its historical range, often printing in the low to mid-teens. During this time, the VIX remained firmly below its 200 SMA, indicating that the market was generally unconcerned about near-term systemic risks. This extended period of low volatility fostered an environment of high confidence among equity traders. As the market progressed toward the traditionally more volatile autumn months, the relationship with the 200 simple moving average became a focal point. True to seasonal form, the VIX experienced a notable increase in August and September. This rise was typically driven by renewed concerns over macroeconomic factors, such as central bank policy uncertainty, inflation data, or geopolitical events. During these periods, the VYX would often climb sharply, temporarily breaching its 200 SMA to the upside. It is essential to note the mean reverting quality of the VIX. Spikes above the 200 SMA were generally short-lived. Traders viewed a sharp jump significantly above the 200-day average as a potential buying opportunity for equities, as it signaled a peak in fear. Conversely, the VIX would then swiftly drop back toward its 200-day anchor as market fears subsided and the underlying equity indexes stabilized. If we look back 30 years from the mid-1990s to today, the U.S. M2 money supply has grown at an estimated compound annual growth rate of about 5.6%. Now, 5.6% might not sound like much, but when you compound that for 3 decades, it means the total amount of money in the system has multiplied nearly sixfold. The growth rate is higher than both long-term inflation and typical economic growth. So, what does this massive expansion mean for your wallet, for the price of milk, and for your investment portfolio? The traditional old-school economic view is very simple. If the money supply grows much faster than the number of goods and services being produced, you get inflation. Too much money chasing too few goods is a classic recipe for rising prices. This is the quantity theory of money. However, the real world is complicated. Over the last 30 years, especially since the 2008 financial crisis, the simple link between a growing M2 and consumer price inflation, like the CPI you see in the news, has weakened. Why? Because of something called the velocity of money. Think of velocity as how often a dollar changes hands in the economy. If the M2 supply is high but the velocity is low, meaning people are saving, paying down debt, or simply hoarding the money, that new money isn't aggressively competing for basic goods and services. It sits on the sidelines, dampening consumer price inflation. But here's the critical implication. The huge, expanding M2 pile provides a massive reserve of potential spending power. It's fuel for inflation. If consumer and business confidence returns, or if a major economic event causes people to suddenly start spending those savings, the velocity could surge. If that happens, you could see a rapid, sustained spike in prices for everyday goods, exactly what we experienced in the early 2020s. For investors, M2 expansion offers 2 key signals, depending on whether it leads to high consumer price inflation or not. When the money supply grows but consumer prices stay relatively calm, the excess liquidity often bypasses the grocery store and flows straight into financial and capital markets. This phenomenon is known as asset price inflation. Investors who see a constantly increasing money supply are often willing to pay higher prices for stocks, real estate, and private equity. This can drive up asset valuations, creating a wealth effect for those who own these assets. In this environment, investors typically favor growth stocks and are comfortable taking on more risk. The inflation hedge shift. If the expanding M2 starts to translate into painful, sustained consumer inflation, like what we saw in 2022, the game changes. High inflation erodes the value of money and any asset that pays a fixed return. In this scenario, investors pivot to assets that are considered inflation hedges. Commodities. Assets like gold, oil, and industrial metals often perform well because their prices are the very things driving inflation. Value stocks. companies that have strong pricing power and can easily raise prices on their customers without losing business. Short-term bonds. Investors shorten the duration of their fixed income holdings to reduce exposure to future interest rate hikes by the central bank. In summary, M2 is a critical indicator of liquidity. While it doesn't guarantee consumer price inflation thanks to the variable velocity of money, it provides the underlying energy for it. For investors, monitoring the size and velocity of the M2 money supply is key to deciding whether to pursue growth or shift toward defensive inflation hedging assets. U.S. house prices fell 0.1% in July, according to the U.S. Federal Housing Seasonally Adjusted Monthly House Price Index. House prices rose 2.3% from July 2024 to July 2025. The previously reported 0.2% price decline in June remained unchanged. For the 9 census divisions, seasonally adjusted monthly home price changes ranged from minus 1.2% in the Middle Atlantic Division to plus 0.3% in the East-North Central Division. The 12-month changes were all positive, ranging from plus 0.2% in the Pacific Division to plus 5.1% in the Middle Atlantic Division. The Fed's current target rate is in the 4 to 4.25% range. The FOMC dot plot, as you see, indicates a high probability of a further 25 basis point cut at the October meeting and the potential for further cuts into 2026. The Federal Reserve's primary motivation for considering further rate cuts in October 2025 and into 2026 centers on growing concerns about a softening labor market, despite inflation remaining somewhat elevated. The Fed projects the unemployment rate, which was recently around 4.3%, to rise slightly to 4.5% by the end of 2025 before ticking down in 2026. So there is a bit of a tricky balancing act the Fed needs to pull off. The primary driver for recent and expected cuts is the significant slowdown in job growth, with some reports indicating hiring has slowed to a near standstill. Substantial downward revisions to previously reported payroll figures have painted a weaker picture of the labor market over the past year. Fed Chair Jerome Powell and the Federal Open Market Committee, FOMC, have indicated that the downside risks to employment have increased, justifying rate cuts as a risk management action to support job growth and prevent a sharp rise in unemployment. Inflation remains elevated but manageable. Core personal consumption expenditures, the Fed's preferred inflation gauge, remains above the target of 2%. Projections suggest it may not hit the 2% target until 2028. The effects of tariffs, which have been noted as pushing up some prices, are complicating the inflation picture. Rate cuts in October to 2025 and into 2026 could be largely seen as an insurance policy to bolster the weakening job market, even as the Fed continues to wrestle with inflation that is still above its target. Meanwhile, the poly market odds for a recession in 2025 have dropped to 7%. At the end of June, the odds were 27%. The Merrill Lynch option. Volatility Estimate Move Index reflects the level of volatility in U.S. Treasury futures. The index is considered a proxy for term premiums of U.S. Treasury bonds, that is, the yield spread between long-term and short-term bonds. In Q3, we saw a clear easing of implied volatility in the U.S. Treasury market. Although there were slight increases at times, the overall trend for Q3 2025 was downward. This lower level generally suggests a calmer bond market, though analysts typically consider the normal range to be between 55 and 130, so we're near the middle of that range. An expected easing cycle, especially one aimed at managing a cooling labor market, could initially reduce bond market uncertainty and put downward pressure on the MOVE index as long-term bond yields stabilize or decline. However, forecasts for U.S. GDP growth in Q4 2025 suggest a below-trend growth scenario. A continued soft landing or slower growth environment, if orderly, could keep volatility subdued. Despite a perceived cooling, ongoing policy shifts, particularly around tariffs, are still cited as a key source of elevated macroeconomic uncertainty that could cause sudden spikes in bond volatility. And, of course, there is the ever-present U.S. federal debt that looms over the bond market. Elevated government debt and fiscal pressures are factors that could continue to exert upward pressure on long-term bond yields and potentially on volatility. The S&P 500, representing broad market exposure, is up a solid 13% YTD. All sectors are green for the year, and we see the outperformance of just a few sectors. The clear winner this year by a significant margin is the communications sector, boasting a stellar 23.6% return. Right on its heels is XLK, which delivered a very strong 18%. These two sectors, often home to the mega-cap tech giants, have been the engine driving the broader market. Their success highlights the continued investor enthusiasm for growth, innovation, and artificial intelligence, a theme that has dominated headlines and portfolio allocations. Also notable in the winners column is the Industrials Index 41, with a respectable 16%, suggesting that a resurgence in manufacturing, infrastructure spending, or industrial efficiency is providing a strong tailwind to that part of the economy. Here's another look at sector performance going back pre-pandemic. Again, XLK and XLC being the leaders, with energy and real estate being the laggards. And we'll close today's session with gold. What is there not to like about gold? Pick a pattern, pick any TA you'd like, along with the fundamentals. And gold remains a top performer in 2025. Will the gold rush stall in 2026? Maybe not. When real interest rates are low or falling, the opportunity cost of holding gold is reduced, making it a more attractive investment compared to assets like bonds. Expectations of interest rate cuts by central banks can therefore push gold prices higher. When the US dollar weakens against other major currencies, gold becomes cheaper for foreign buyers, which can increase demand and drive its dollar price up. Central banks, particularly those in emerging markets, have maintained a rapid pace of gold accumulation throughout 2024 and 2025, driven largely by strategies to diversify away from the US dollar and hedge against increasing global geopolitical and economic uncertainty. This robust official sector buying has been a primary factor supporting the price of gold, which has hit multiple record highs during this period. The data highlights several key national buyers leading this structural shift. The National Bank of Poland stands out, having been the largest net purchaser in 2024 and maintaining an accelerated pace into 2025. This aggressive buying is explicitly aimed at increasing its gold holdings to approximately 20% of its total reserves, reflecting heightened concern over regional instability. Meanwhile, the People's Bank of China continues its consistent, multi-month streak of officially reported purchases. China's central bank gold acquisitions are viewed by analysts as a key long-term initiative to build a more robust, self-reliant financial position and decrease dependence on Western currencies. Many observers believe China's actual tonnage bought is substantially higher than the publicly disclosed figures. Other prominent central banks making significant purchases include Turkey, which is actively boosting its reserves to combat high domestic inflation and currency volatility, and the Reserve Bank of India, which is steadily adding to its official holdings as part of a broad reserve diversification strategy. Further buying activity has been recorded from nations like Kazakhstan and several Middle Eastern sovereign funds and central banks, demonstrating a widespread global consensus that gold is a critical asset for stability in an unpredictable macroeconomic landscape. This sustained demand from official institutions signals a lasting strategic shift rather than a temporary market correction. That's all for this video. If you find this content useful, please give us a like, and don't forget to subscribe to our channel to receive notifications when we publish future content. We'd like to hear your insights about the current macro state of the world, so post your comments. Thanks for tuning in, and we'll see you next time.